Hello, and welcome to today's webinar. I'm Susan Keating, CEO of Women Corporate Directors Foundation, a 501c3 nonprofit organization with a twofold mission: to inspire and educate board members around the globe on matters of corporate governance, and also to serve as a powerful advocate for greater diversity on corporate boards. We have 80 global chapters and more than 2,200 members. And as such, we are the largest membership organization for female board members in the world. We are delighted today to have WCD sponsor Pearl Meyer as the co-producer of this webinar. I'd also like to remind you that WCD has several upcoming programs for corporate directors that we hope you will attend, including a private family company director summit in Orlando, January 9th. We also have the Asia Pacific Institute in Tokyo, Japan. That is February 21st and 22nd, 2019. And the Global Institute in Silicon Valley, May 19th through 22nd. So if you would like to learn more, and we hope you will, there are more details on our website, and that website is WomenCorporateDirectors.org. And now I'd like to briefly introduce our speakers today. First, we have Karen Smith-Bogart. Karen is president of Smith-Bogart Consulting and has served on 10 U.S., Canadian, and Asian company boards. She currently serves on the boards of New York Stock Exchange-listed Mohawk Industries and Michelin Incorporated, a private specialty chemicals company. She's also a member, and we're delighted about that, she's also a member of WCD. Next is Jan Kors. Jan is a senior managing director with Pearl Meyer and president of the firm's Western region. She has more than 25 years of experience in executive compensation and governance. She advises boards, she advises management teams, and she does so on all aspects of education and executive director compensation design, performance measure selection and calibration, and related corporate governance issues. Jan is a sponsor and a member of WCD. So now I'd like to just take you through a couple of brief housekeeping items. If you're listening through your computer speakers, a secure internet connection will provide the best quality audio. For a wireless connection, it's recommended that you mute your speakers and dial into the audio portion at 888-394-8218, which is, and we have a participant passcode of 767-8688. This webcast is being recorded and all lines will be muted during the presentation. If you need technical help, dial *0, literally *0, and please use our online chat window to ask a question. So now I am very pleased to turn this webinar over to Jan, and Jan, I'll let you get us started.
Great. Thank you so much, Susan, and thanks to everybody on the phone for giving us a little bit of your time today. And I apologize in advance for my cough. As we think about what's going on in the compensation committee rooms and what all of you are dealing with in terms of your agenda, one of the things that we've noticed over the past several years is that the term compensation committee is increasingly becoming a bit of a misnomer, that in fact committees and boards are being asked to deal with much more than just compensation. If you think about the historical, traditional, and somewhat narrow definition of the purview of the compensation committee, it was to set the pay for the CEO and a handful of other senior executives. We are increasingly seeing compensation committees spending time on broader-based issues. The CEO pay ratio this past year was an example of that. We are certainly seeing companies spend time on the gender pay issue and other inclusion and diversity issues. There is increasing focus on the need to retain and develop talent and recruit talent. As we watch unemployment rates continue to plummet and the pressure that that puts on companies to be able to recruit the talent they need, keep the talent they need, We're also seeing a number of human capital related issues around corporate culture. Certainly the hashtag #MeToo issue has loomed large the past several months, but even before that you had Wells Fargo and the implications that much of the problems at Wells Fargo was driven by a corporate culture that incented executives and people lower in the organization to falsify forms and accounts. Similarly, there were cultural implications to the issues around Volkswagen and the falsification of tests there. And all of those human capital corporate cultural issues have bubbled up to the board level and often find themselves a home in the compensation committee, because that is the place where human capital and human resources issues reside. So in keeping with our theme for today's discussion around data information and how that may help us to inform our business strategy around human capital, we want to touch on some of these issues, provide you with some data, some thoughts, some insights, but we also want to collect the data from you. So let me just move us to our very first polling question for the participants on the phone. Our first polling question is, does your compensation committee charter outline responsibilities that go beyond just setting executive and director pay? And we are looking for you to click the button on yes, no, or unsure. Let me move to the place where you can click your button. So here you can click your button. Does your committee's charter outline responsibilities that go beyond just setting executive and director pay? Yes, no, or unsure. While people are tallying their polls, and I'll watch it on the side, once we see the results we'll close the poll and put up a chart for everybody to see. But Karen, what's your experience on the boards that you sit on?
Well, Jan, I think that the comp committee often opens the conversation. And I think, from a HR practice and policy, what we do around selection and leadership development, as well as incentives, have to be aligned and integrated. And they have to make sense not only internally but externally, because all of these align with the social contract that a company has, as well as focusing on the achievement of the business objectives. And so there's more and more of an understanding that you can't look at compensation in isolation. Rather, it needs to be integrated.
Okay, it looks like we've got, I'm going to close the poll. We'll see the results here. When you look at it, we've got, we've got roughly 50% of the people who responded saying that yes, the charter for their compensation committee goes beyond simply executive and director pay. About a little less than a quarter saying no, and a little more than a quarter saying they're not sure. That is interesting relative to the findings we have from a survey that Pearl Meyer did earlier this year, asking a similar kind of question. When you look at what the committee oversight responsibilities are, we see, in addition to executive comp, we see about 75% of the folks that responded to our earlier survey said they also do board of director comp. In my experience, board of director comp either resides in the compensation committee or it sometimes resides in the nomination and governance committee, because that's where other board related issues get dealt with. Interestingly, about 67% of our earlier survey respondents said the compensation committee also handles succession planning, and about 41% said leadership and talent development. Those two things kind of go hand in hand. Only 22% of our earlier survey found that the comp committee also had some sort of responsibility for corporate oversight. Karen, I'd be interested in your experience on this as well. In my experience, these issues, particularly the corporate culture oversight and to a lesser extent the succession planning and the leadership talent development, often are elevated almost to a full board discussion rather than residing in any specific committee. So from my take, I would look at this and say these numbers may be a little understated only because it's almost as if it's not that these issues haven't risen to a board level of discussion. It's just that they've almost skipped the committee purview and gone straight up to the full board.
I think that's true. I would agree with your assessment. Again, I think the committee increasingly is the source because it looks at tangible and intangible incentives, are beginning to ask, do we have the right policies? Do we have the right practices? Forming where do we need to do more analysis to understand where we stand and where we want to be?
Right. So I would expect that over time we will see, even if you've got something that you're dealing with issues at the full board level, oftentimes where there's homework to be done or further issues to be delved into, you push that back down to a committee to kind of do the legwork, if you will. And to me, it would seem that the most obvious place for some of the legwork to be done on these kinds of issues is the compensation committee, because that's where other human resource issues are being dealt with on a general basis. I want to turn now and talk a little bit about some of the particular issues that we're seeing around those broader-based employee issues. So starting with the CEO pay ratio, we just had for 2018 for publicly traded companies the first disclosure on the CEO pay ratio. And interestingly, it didn't really generate the kind of brouhaha that we expected. It really didn't get a lot of coverage in the media. More importantly, it didn't really seem to generate much discussion or water cooler talk among employees. Again, we did a survey on communications issues around employee pay topics, and our survey found that when we asked our HR departments if they were fielding questions about the CEO pay ratio disclosure, the vast majority of respondents said, actually, no, we're not. Again, we had a lot of our clients whose HR departments spent a fair amount of time preparing for the proverbial line outside the door of half of the employees who were being paid below median. And that line outside the door just never materialized. That said, I don't think I would caution companies against being too complacent that because the first year of the disclosure was a pass, that they now don't have to worry about it and the CEO pay ratio can go on autopilot. I think there are a few things to keep an eye on here. One is kind of the additional information that comes from second-year disclosures. You'll now be able to see year on year what happens to that pay ratio. I think companies are at some risk when you start looking at how things change and say, well, the CEO's pay went up 20% versus last year. Maybe you had a good year, maybe some bigger equity grants. CEO pay went up 20%. The median employee's pay only went up 3%. What's up with that? It could potentially generate some additional questions that didn't come out of year one because year one was setting a baseline. The second thing to keep an eye on is that also year one, because it was a baseline, neither ISS nor Glass Lewis really did anything with that data. Historically, Glass Lewis and ISS have both taken quantitative information that's put in disclosures and has done something with it, has rated it, has ranked it, has used it in their analysis. They didn't with this disclosure. That doesn't mean they won't in the future. The third thing to keep an eye on with regard to the CEO pay ratio is the risk that this gets used for unintended consequences. There are a few, not many, but a few jurisdictions who have actually proposed tax rules that would create penalties for companies that are headquartered in their jurisdictions where that CEO pay ratio is deemed to be excessive. So, not what the disclosure was intended to do, but that doesn't mean that some states or municipalities wouldn't look at that and say, this is a way to generate some tax revenue. So I think there are a few things to keep an eye on as committees think about playing defense. I think the other thing to think about is how you take CEO pay ratio and other broad-based information like that and use it to play offense. In the same survey that we were looking at where we asked whether or not employees had asked about the CEO pay ratio, we also asked whether or not as an HR department you thought that your employees really understood how their pay programs work relative to market practice, and do you think your employees really understand how to assess their own pay relative to their colleagues, their peers? And in both cases, the resounding results or opinions of HR professionals is that no, employees don't understand how their pay programs work. As we live in a world where there's increasing pressure on how to attract and retain and motivate employees, this strikes me as a great opportunity to use that pay ratio or gender pay things, which we'll talk about in a minute, as a way to really open up a dialogue with employees to give them more information around how the pay program actually works and why it works the way it does. Before we move into the gender pay issue, Karen, I'm curious whether or not your experience around the CEO pay ratio as you talked about it in your boardrooms was similar to this. It seems like, again, for a lot of my companies, a big ho-hum.
We thought, obviously, like many others, when this became a requirement, that it would take, first of all, a lot of time, and that there would be a big reaction both internally and in the press. And a couple of the companies that I work with have a lot of their operations in near geographic presence, so we get a lot of press typically. This ended up being a non-issue, but I want to highlight your comment. It provided an opportunity to ensure more communication about pay, more communication about broader compensation, and that the CEO compensation is just one element. We do the same things. We look at the market. We look at being competitive. We try to use appropriate peer groups for talent. And so it had a positive opportunity to talk about the broader compensation issues.
So I continue to think that the book may not be completely closed and written on the CEO pay ratio. I still think that there may be, I don't want to be Chicken Little crying the sky is falling, but I do think that we need to continue to keep an eye on it. Just because most companies kind of breezed through year one doesn't mean that there won't be some follow-on issues as we get to year two and beyond in terms of disclosure. I want to move to the gender pay gap because, again, from where we sit, whereas the CEO pay ratio didn't seem to generate a lot of interest or energy in the boardrooms of most of our clients, it was viewed more as a nuisance disclosure than anything. The gender pay discussion does seem to generate a fair amount of energy and interest at the board level. And here, I think the important thing is to kind of make sure that everybody's talking with the same language. And while the press will tend to conflate issues and use words and terms fairly loosely, we want to have companies think about it from a pay gap versus pay equity. They're two different things, and as board members and as a management team focusing on these issues, you have to make sure that you know which one of those two things you're talking about. So the pay gap, which is what gets talked about and tends to get talked about in the popular press, the pay gap is the thing that the UK reported in their public disclosure this past year for the first time as we were doing CEO pay ratio. UK-based companies were doing pay gap disclosure, and it is kind of an absolute kind of gross measure of the differences between how much men make and how much women make in aggregate. You take all the men in your organization, you take compared to all the women in the organization, and the difference between what the median man makes and what the median woman makes is your pay gap. That is very different from pay equity, which is this concept of equal pay for equal work, or as we're starting to see in some state legislation, equal pay for comparable work, not quite the same thing. And we've got examples here. So equal pay for equal work would be, do teachers make what teachers make? Do accountants make what accountants make? Versus equal pay for comparable work is when you look at the skills and the training that's necessary or the experience that's necessary for a role, is there equal pay for comparable work? Janitors are not being a janitor is not the same job as being a cafeteria worker, but you could argue that that's comparable work in terms of the education required, the skill required, the hours you work, that sort of thing. So this notion of pay gap versus pay equity is a really important concept. When you look at how that plays out in the numbers, what we find is almost all companies, if you were to point in time today, almost all companies are going to have a gender pay gap. As you see over here right now, if you look at kind of a broad-based survey, the gender pay gap, all working women compared to all working men, women earn about 78 cents on the dollar. That is largely because you've got, as you go up in an organization, the number of women falls off. So just again, take all of the people in an organization, line up all the men on one side, line up all the women on the other side, rank their pay high to low. The median man is going to have higher pay than the median woman because at the CEO level, 95% of the incumbents are men versus women, where you get to all employees, it's 50-50, but the more high earners, the more likely it is to be a man. So it's math. Interestingly, when you do the pay equity analysis, that equal pay for equal work or equal pay for comparable work, the difference based on gender shrinks. It goes from 78 cents down to 98 cents. So when you start to weigh in explanatory factors like function and tenure and experience and education, all of those gap differences fall away. Equal pay for equal work, much closer to even Steven. I would argue that even there, though, what that equal pay for equal work doesn't take into account for is what I would call a pink collar discount. So the fact that when you look at jobs that are held historically primarily by women, they tend to get paid less than jobs that are historically held primarily by men. Just as a quick example, obviously lots of other things going on, but so for example, a social worker, which is a position that is held primarily by women, typical median pay is about a little over $45,000, whereas a software developer, a position that is typically held primarily by men, has a median pay of $80,000. If you were to do a pay equity analysis, all of the men and all of the women in the social worker category probably get paid pretty close to the same, but they all get paid a lot less than software developers do. So I think, so here I would say that, and then Karen, I'd love to have you kind of weigh in as to how you guys are thinking about these issues. I think you have to look at both of these numbers, and each of them have different root causes and have different potential resolutions. Both numbers tell you different things, and both numbers imply different results. Maybe, Karen, while you're kind of weighing in on this topic, we'll have people do their second polling question, which is, has your board had discussions with management about gender pay equity or the gender pay gap? Yes, no, or unsure. I'll move on and let people do their voting. But Karen, how are you guys thinking about these issues?
Well, first of all, we're in the process right now of understanding the concepts and starting the analysis. And I think that the analysis is critical. And as you noted on the page of 5% CEOs, 11% top earners, you need to know where you are. And because there are a lot of pipeline issues in many companies. And so it's an assessment of where are we, what do we need to do, what policies and practices do we need to change in selection, development, reentry for people returning to the workforce, which helps women and men. What are the opportunities that we should be proactively addressing? Because obviously if we don't do anything, we're going to continue to have these disparities. And so we really have focused on, first of all, understanding the difference between the two concepts, but recognizing that the gender pay equity provides us an opportunity to really look holistically at where we are and how we want to change for the future. And again, this goes back to we're going to lean into the war for talent, and this is an opportunity to address it in a different way, and one that will have a lot of positive impact.
Yeah, I am. And here I guess let me close the poll out so we can look at results. And again, almost half of companies have at least started the discussion with their management team. A little over a quarter haven't, a little over a quarter, and about a quarter not quite sure where that discussion is. I think here it's really important. The thing that I have found interesting is that many of my board members, and I will caveat by saying that it is oftentimes the male board members, have a preconceived notion about what the problem is and what the issues are. I had one board member say to me just last week as we were preparing materials to talk about this at the next compensation committee meeting, saying, why are we even showing the pay gap numbers? We know we need more women in the pipeline. Why are we even focusing on that number? It's a stupid number. Like, not a stupid number. You kind of have to know, to your point, Karen, you have to know where you are. Not that it's necessarily new news, but you do have to know where you are on both of these issues, because the answers are different in terms of how you solve the problem. But secondarily, you may think, people may look at that pay gap number and say, well, duh, of course we've got a pay gap. That's not information that tells me anything. But in terms of disclosure, certainly for public companies, if we get around to disclosure, that pay gap number is most likely the number that will end up being in any kind of public disclosure. Because it will follow. The easiest thing for the SEC to do is to follow suit from the UK, and that pay gap number is the disclosure that the UK has. So I think it's really important that companies kind of at least know where they are, to your point, Karen, on both numbers in terms of how you solve for the problem.
Right.
I want to touch a little bit on other ESG issues as well. The gender pay, gender equity issues certainly are the things that tend to be front and center right now, but they're not the only ESG things that companies are asked to be focused on of late. We've really seen a big increase in investor interest in all issues around environment, sustainability, governance, just kind of rethinking what it means to be a good corporate citizen. Increasingly, we're seeing big investors, BlackRock, Vanguard, JANA, Trian, Value Act, all look at ESG issues, open ESG funds. In fact, I saw a statistic recently from a Morgan Stanley study that says currently $1 out of every 4, so 25% of all of the money under management is in the ESG space. So you're talking about ESG-related funds of nearly $25 trillion. And importantly, the impact that has is you've got companies and investment dollars who are looking at companies and saying, your position as a company on the ESG issues that we care about are either going to be the reason that we invest in you, or importantly, the reason we don't invest in you. The interesting thing that's come out of that for me is that as you see more investors start to care about those things, we're also starting to see more quantitative analyses, more comparable tools, more ratings. You've got Yahoo Finance right now that now provides a Sustainalytics score for companies. ISS just this past year implemented an ESG quality score in its reports. To date, ISS doesn't use that score for anything, for any kind of voting recommendations. It is just informational. But again, not to say that they won't use it in the future. To date, they haven't. But I think it's telling that a company like ISS, which presumably is there to serve its investor clientele, has said, our investors care enough about this that we're at least going to develop a rating and start giving companies comparative scores. But interestingly, kind of on the flip side, is despite the fact that we see more and more heavy hitter institutions say we care about this, we haven't seen it really migrate into executive incentive plans yet. So kind of metrics that we hold management accountable to in a financial way with regard to their incentives. Again, we asked in a recent survey, do you as companies, and it was a survey that was participated in by both management as well as board members, does your company use ESG in its incentive as an incentive measure in its plans? And more than 50% of both management and boards said, not really. We have, we've thought about it maybe, but we haven't really done anything. It hasn't really been on our radar screen, or no, we're not doing anything at all. And I think it's interesting that while we're seeing so much information and so much focus from outside institutions, which you would think would drive a focus at the board level, we're not really seeing that. While it may be talked about in terms of incorporating it into a company's strategy and philosophy, what we haven't yet seen is we haven't seen it make its way to how senior executives get paid.
Jan, this is where,
yep.
Yes, this is where you use the word yet in your slide, and I think, again, in transition now, there's a lot of data to indicate that attention and proactive action on environmental, social, and governance issues actually yields greater long-term shareholder value. And it has impacts on not only operations, the brand, reputation, value. So I think we are going to see an increasing recognition of it in metrics associated with certainly management and the CEO. And so I think, again, this is one that because of the impact in the company, this will change. And in a few years from now, I think the results will be very different.
Yeah, I think, again, and I think when you start thinking about kind of the difference between the metrics you use to run your business versus the metrics you use to pay people, you can kind of understand that there can be a difference between those two things. The other thing is, historically, there's been this notion, that any measure that was soft, where we couldn't actually put hard numbers around it, was hard to use for an incentive plan, because you need to be able to quantify results for an incentive plan. And historically, to the point above, historically there haven't really been good metrics around ESG issues, and certainly not good comparables to be able to compare how you do versus how your peers do around ESG measures. Increasingly, as I noted above, there are those kinds of not only quantifiable metrics, but also ways to compare your performance relative to your peers or the market in general. So I think that will help to kind of push that change as well over time.
Agreed.
The next thing I want to talk about is this notion of the war for talent, that you've got unemployment rates that are the lowest we've seen in some time. We've had changes to 162M, which sort of potentially loosens up or frees companies to rethink how they pay people. And yet, despite the fact that we've got this war for talent, that we've got some changes, some regulatory changes on the horizon, we haven't really seen that translate into big changes in pay programs or pay structures yet. We did again ask a survey of folks around what they're projecting for 2019 for their executives, for CEO increases as well as their direct report increases. The median expected salary increase was only 3%. That is very consistent with World at Work's survey, where they're looking at projected salary increases for 2019 across the broad base of employees, that number 2. is only 3% at median, which is the same thing it's been for the past half a dozen years. So we're not seeing this presumed tightening in the labor force translate into into higher expected increases in salary budgets across the board. We are not seeing the 162M changes translating into any big changes in how executives are paid, a bigger shift to fixed pay because now you don't have to worry about $1 million caps on salaries anymore, or anything else. We're also not seeing this sort of concern over workforce and retention and recruitment really translate into changes in market positioning. The vast majority of companies still say that they target their pay at competitive median. Even, there is certainly some concern for public companies that anything over median gets you some negative feedback, but even private companies, we're finding the greatest preponderance of companies say that they target competitive median. And you would think that if there were really concern about holding on to people, that you'd start to see the competitive positioning start to creep up as a way to have a pay package that is potentially more attractive. And we haven't seen those things yet. And here, and again, Karen, it'd be interesting to know if you're hearing your management team. This is an alarm bell that tends to get raised by management earlier than boards around a concern over retention, and it shows up as a concern over retention. I think if you go back a couple of years, most companies, most boards were skeptical when management said we're concerned over retention. The thought being, well, where are people going to go? I think that concern over retention is starting to feel a little more legitimate to me. But I think, and I think this data, because data is always backwards looking, the data may not actually be as up to date with where people are feeling like they are right now, boots on the ground. And I'm just wondering, Karen, whether you're starting to hear your management teams start to raise that retention concern, recruiting concern in your boardrooms, or whether you're starting to see any kind of pressure around, boy, we really need something bigger than a 3% salary increase budget this year. Those kinds of discussions.
Well, first of all, I think that there is a tendency to look back, and compensation planning has often had a retrospective view. No question, we're seeing increasing difficulty in recruiting the candidates, the key candidates with the critical skills that we need. I mean, there is a war for talent. I think that there absolutely is more concern about retention and how we can be more creative. I mean, turnover is sort of a too late kind of a measure. So I think that's one critical issue to be watchful about what is happening in the market. Now, one of the positive things that came out of the recent tax change was around the change to the 162M, and I really view this because it allows the comp committee more flexibility. It allows more consideration and appropriate use of positive discretion. And so comp committees can recognize extraordinary performance, particularly looking at really stretch goals, It might be, critical achievements in innovation, things that will have longer-term impact on the company. And so I think that the 162M, we have not yet begun to see what I expect to be a more creative use of new capabilities to be able to motivate and reward performance much more than we've had in the past. And I would agree with you. I think we're going to see some changes in the pay mix and in the structuring of metrics as well. They still need to make sense both internally as well as to the shareholders and proxy advisors. They have to be explainable, but I view this as a very positive change.
Yeah, I agree. I think, on the one hand, there's no question, it's not going to have the result of lowering executive pay. Regulation almost never does.
Right.
So by virtue of losing tax deductions, executive comp got more expensive because of the change to 162M. But I think putting all of the elements of compensation kind of on the same tax footing is actually a good thing. I think it will. I think you're right. This will be more evolutionary than revolutionary. But
Yes.
But I do think it's coming, the change.
Agree.
The last item I want to touch on very briefly is director compensation. Typically, we don't talk about director comp a lot in these trends things because, frankly, director comp doesn't have enough zeros behind it to be very interesting to people. However, I do want people to be aware that ISS for the first time in 2019 will be looking more carefully at director compensation and doing it in a more quantitative way. They have identified kind of a yardstick they're going to use to identify companies where they feel director pay is excessive. That yardstick, so kind of tripping that wire won't necessarily get you a no recommendation on the directors who are responsible for setting director pay, but tripping the wire does put you under closer scrutiny for them to then make a qualitative assessment. That trip wire they have set at a 95th percentile of comparators. Which sounds completely reasonable. Oh, well, of course, if a director is being paid in the top 5%, that's too much money. But recognize from a quantitative perspective, director comp tends to have a much narrower band to it than executive comp. So as an example, we've got for you here, if you were to look at the 30/30 GICS code, so consumer staples, household, personal products, the 95th percentile for director pay in companies in that GICS code is only 14% higher than the median director pay in that GICS code. So it doesn't actually take very much to trip that 95th percentile wire. Things to pay attention to that might inadvertently result in one of your directors tripping that wire would be, do you still have meeting fees as opposed to retainer? Do you do initial election equity grants that are larger than your regular grants so that in their first year their comp is going to look high? Do you do fixed share grants? And have you had a run-up in your stock price that might mean that this year's equity value is high? Do you have ad hoc committee assignments, either ad hoc committees or you've asked one of your directors to do some additional work and you're paying him or her per diem that could exacerbate their individual pay in a given year? Do you have a transitioning executive, a retiring CEO who might have very high compensation because his pay is in transition? Things to be aware of that might inadvertently end up tripping that 95th percentile test, even though structurally your program really isn't all that out of line with market practice. things to be aware of. So here's our last polling question on that. Will you be reviewing your director pay level against that ISS quantitative test this year? Yes, no, or unsure. I'll move us to the testing.
Jan,
yeah.
Jan, we do have a question on CEO pay that we just received. I want to share it with you. And while we're tallying the results on director comp,
sure,
exactly, I can answer that. I recently heard that CEOs, as highly competitive people, demand higher pay because they want to be at parity with their peers, not because they need more money. Is there any discussion to change the compensation environment for publicly traded companies so that pay isn't the only measure of a CEO's value?
Wow. Gosh, and after that we're going to tackle world peace. I think that's a really good point. I do think that and while this is, I'm going to just skip to results as we're doing this. Let me close the poll, skip to results. Seems like the jury is still kind of out on looking at director pay. One of the things that I would say with regard to CEO pay is, yeah, of course they're competitive people. That's how they got to be as successful as they are. And one of the downsides of all of the disclosure that we have around executive compensation is, every time you disclose a new piece of data, you give a whole bunch of really competitive people something new to compete against. I do think that part of what we've seen over time, it's probably not perfect yet, certainly, but I think one of the things we've seen over time is as you start to see companies pay more attention to not just the absolute dollars, but the pay for performance relationship. So not only is my pay high, but is my performance high such that it warrants the pay? I think that changes the discussion a little bit. It changes the focus a little bit. It has certainly, I think, reined in some of the worst examples of runaway pay where performance didn't warrant it. But yeah, there's probably more work to do there. Karen, I don't know if you have a thought on how we get CEOs to be competitive about something other than their pay.
I think I agree with you relative to performance, and obviously a lot of CEOs will identify the highly paid sort of superstars that are out there. And I think it comes back to what is the appropriate thing for the company, how does it fit with the broader compensation philosophy and what the business is trying to do. And this also goes back by the more creativity, which the 162M changed, which is what does the business require? Are there unique business characteristics that should be recognized? But also then, what is the appropriate target group to be looking at? And we're not going to make every CEO happy. In fact, I think that's a normal part of the comp committee discussion with the CEO about what really is appropriate. But that is a tough issue.
So in our last few minutes, I just want to recap what we see as items to pay attention to and think about as we head into wrapping up 2018 and looking ahead to 2019. Certainly, one of the things that we continue to see is the expansion of oversight for the compensation committee, paying attention to non-compensation, non-pay issues. That said, I think it's important that committees don't run roughshod over management, but engage in a dialogue with management about, how can we best be supportive of what management's trying to do. Helpful and asking the right questions, but not intrusive into what they're trying to do. We certainly don't want to be shadow management. As we look at broad-based issues, I think the key is don't just ignore the CEO pay ratio in year 2. Pay attention to it and just make sure that nothing comes up and bites you by surprise. Gender pay equity, I think, will continue to be a real issue. It is about not just are we paying people fairly, but are we giving people fair opportunities for advancement as well. So it's partly a pay thing, but it's also partly a succession and talent development issue. Third is keeping an eye on recruiting and turnover trends. I think Karen made a really good point about, you need to watch that turnover trend, but recognize that, if you've got a problem with turnover, it's almost too late. It's like that's the problem manifesting itself. You want to try to figure out what you can do to get ahead of it. And then lastly, on the director pay issue, while for most companies it's not going to be a problem, you do need to at least do some kind of a cursory review to make sure that you're not inadvertently tripping that 95th percentile tripwire, and if you are, that you've put in some extra information or explanation in your proxy disclosure as to why the pay for this particular individual or this particular committee seems a little elevated in this year. Karen, any additional thoughts that you have around kind of key takeaways for the group?
No, other than the fact that I think the external landscape is increasingly interesting. It's exciting to integrate all of the HR practices and policies and helping goals. Comp has always had a more direct impact because of the incentives issue, but I think now it allows a much more fluid and integrated opportunity to use HR capabilities of achieving business impact.
This is Susan Keating, and we're just checking to see if we have any more questions from any of you that are participating today. Give it a quick pause. Jean, what do you think? Jan and Karen?
Yep, we have one more. Maybe we can quickly answer it. As more women are brought in. Jan, are you there?
Yes, I'm here.
Okay. As more women are brought into boards, how can women negotiate directors' compensation that has equity with male directors?
I would say that in general, director comp actually is pretty much at parity. The thing that creates differences, individual differences in director comp, is committee assignments. Mm-hmm. So there, it's really a matter of how you make sure that women are well represented on committees and also as committee chairs.
I would agree with that. Director pay tends to be quite essentially fixed for members, except for your committee assignments and whether you have a leadership role.
Yeah, so that really, to my mind, it's less about the pay and it's more about not surprisingly, like the gender equity issue for gender pay gap for employees. It's less about the pay structure and more about the leadership and the opportunities.
And related to that, this is the pipeline for women to have opportunities to go on boards too. I mean, women are underrepresented on boards at this point, and to me, that's actually the biggest issue that we need to address.
So Jan and Karen, Jan Coors, Karen Smith-Bogart, thank you so much Thank you for speaking today and sharing such incredible content and information. And Pearl Meyer, thank you for co-producing this webinar with WCD. And thanks to all of you for attending. We've run a few minutes over, but we hope you have found the content and this information of value. We will actually upload a replay of this session to the Pearl Meyer and WCD website shortly. And I would just like to say on behalf of WCD and Pearl Meyer, if you will, thank you for joining us today. Thank you.
Great. Thank you.
Thank you.
And thanks to everyone for joining us.